Chapter 3, Richer, Wiser, and Happier. Chapter 3 is about Howard Marks, Chief Investment Officer at Oaktree Capital. Lots of things to learn from him, so let's get into it. The biggest one from him was everything changes. Meaning, if you invested very well and your returns were really good, doesn't mean that they'll stay the same. So you need to build anti-fragility into your investments, meaning don't bet your entire farm, meaning don't go so big into your investment position that you're all in, meaning you can actually lose if you do that in a pretty big way, which you can't even recover from. And so building anti-fragility, being mindful about how much you invest, and constantly remembering how luck and humility is very important to cultivate and to appreciate luck and to cultivate humility. Those were some of the things. And he doesn't believe in efficient market hypothesis, that the markets are efficient. He says, with a simple example, that in Harvard University library, he found a $5 bill lying on the floor. And he keeps that $5 bill in his wallet just to remind himself that there is, you can find $5 bill lying on the floor, because the efficient market hypothesis says that first, it's very difficult if there was a real $5 bill that someone would have picked it up, right? And second, if it was real, if someone didn't pick it up, there would have been many more people who would have picked it up. So you getting it is very rare. So you beating the market is very rare. So just buy the index. So that is the index return. He doesn't believe in that. And he attacks this whole thing in a pretty different way. And I don't think I can emulate any of his philosophy. He goes into assets and areas which are very inefficient. He doesn't even attack the efficient hypothesis or efficient markets or slightly more efficient markets. He goes into areas where no one looks into. So I think this is very unique of Howard Marks and at Oaktree. To find out some of the key insights from him, he says that the world constantly changes. There's lots of disruption. VUCA world, which people have formed the term volatile, uncertain, right? And so how do you get definite answers when you get asked hard questions like what percentage return to expect from the market? Will the Federal Reserve rate increase impact the stock market? What will happen to the commodity prices? So he says it's very hard to predict all of that. So he doesn't even try. So now he's the second person who's telling us that don't even try getting into predicting the macro and how it impacts your investment, right? And so he has a simple insight to share. He's like, be lucky and stay humble, right? First be lucky, second stay humble, right? So he says, focus on what you can control. There'll always be things like the pandemic that can come up, the world wars. You can't control them, and that those disruptions are bound to happen. So reminding yourself how luck has played a huge role in your life is very, very critical, and so that you don't get too optimistic or too egoistic in your decision making and investment. And he goes into less efficient markets. He invests in areas where not many people look into, right? Like convertible securities, high yield bonds, very difficult areas, suppressed assets. And he buys when it's cheap. And he always remembers that luck and intelligence, luck is important, intelligence, hard work, and perseverance are important. But he's emphasizing to remember the power of luck, because based on that you could build your intelligence, based on that you could build your hard work. And so it's important to remember that. The other insight from him is that markets return, the return you get from an investment depends on two things: earnings and the price to earnings ratio, the optimism that's built into the earnings, right, or the share price. So he says that you have to figure out how much optimism is already built into your PE ratio. Again, this is hard. How do you do that, right? Maybe, you can look at the historical return and historical PE averages to find that out, right? Staying detached and unemotional towards stock market movements is another key insight he also shares, like Sir John Templeton in chapter 2. And he says, do what's right for you. Meaning he's looking into distressed asset doesn't mean that you looked into distressed assets, right? So what is right for your makeup is what you should do. Can you really spend the time to invest by doing your own independent research? Do you really have the skills to understand accounting, finance, strategy, valuation, and all of that? If not, you're better off buying the index or giving your money to someone who's a professional, right? He believes big time into cyclical patterns in the stock market, and he studies history of the stock market, and he buys during those cycles. There are times when it is overbought and there are times when it is oversold. And he has this gut feel that he has built through various parameters as to what does the present feel look like. Is it at the height of euphoria? Is it at the height of pessimism? And he buys when it's pessimistic, and he sells when it's euphoria. It's the same analogy. He uses a really good example. It's like when you know that the road is icy, that you're going to drive more carefully. So when you know that the stock market is overpriced or the PEs have gone way beyond, then you would be more careful in the percentage that you allocate to those stocks. And so if the hype is higher, he reduces those positions in those portfolios. So again, that reminds him that everything changes. There's a lot of luck involved, and he's the one who wants to be careful. He goes into inefficient markets which are not studied, not a lot of competition. He wins there, right? So that's his game. He's figured out what he's good at, and he's playing that game. He's not trying to beat Sir John Templeton in the global market. He's not trying to beat Monish Pobrai in the US focused equity market. No, he's like, I know this game, I'm going to go focus on it, and I know how to win there, right? And he's humble and knows that he can't predict. And he has developed this gut of cyclicality of the market. And he behaves counter-cyclically, meaning if everyone's hyper optimistic, he's the most pessimistic. And whenever everyone's the most pessimistic, he's the most optimistic. And he says, never bet the farm. So don't go big into concentration. And that everything is impermanent, and we are skating on thin ice. That's the key. That's just one line. So anti-fragility is what you can learn the most from Howard Marks, right? So, and he says one other thing, and there's a book on anti-fragility by Nassim Taleb. And the key insight with that he's saying is, to the extent to which you're operating at your limits, meaning if you know you can perform at 0 to 10 at 10, and you're constantly at 10 all the time, then you are at your limits. When you're at your limits, your anti-fragility doesn't come in. You are actually fragile. Your resources are used up. You're not recovering enough. You are constantly at the edge, so you can tumble at any point. Similarly, if your investments are at the edge and you don't have any buffer to invest into the downturn, you're screwed. So he focuses highly on being anti-fragile and figure out ways in which you don't bet in such high concentration that it becomes very difficult for you to recover, right? And so the key 3 insights, again, to share from Howard Marks is figuring out which game you're playing. He's playing a very different game into inefficient markets areas that he understands. Not betting the entire farm. He knows that everything changes, that what worked yesterday will not work tomorrow, so he's very careful And he's built that anti-fragility in him in terms of his investment, percentage allocation, and he acts in a way that is counter-cyclical. So he knows what the cycles are and he acts in a very contrarian way. So that's Howard Marks from Oak Tree Capital. Chapter 3 concludes.